So good evening,
Yes.
everyone. We are the group three, and we are here to report our assigned topic. Next slide, please. So the first topic is about adjusting journal entry. So when we say adjusting journal entry, it is an entry in a company's general ledger that occurs at the end of an accounting period to record any unrecognized income or expenses for the period. So when a transaction is started in one accounting period and ended in a later period, an adjusting journal entry is required to properly account for the transaction. Next slide, please. So adjusting journal entries can also refer to financial reporting that connects a mistake made previously in the accounting period. Next slide. So adjusting entries are changes to journal entries you've already recorded. Specifically, they make sure that the numbers you have recorded match up the correct accounting periods. Next slide. So to explain all, so a business needs to record the true and fair values of its expenses, revenues, assets, and liabilities. Adjusting entries follows the accrual principle of accounting and makes necessary adjustments that are not recorded during the previous accounting year. So, cunning adjusting journal entry generally takes place on the last day of the accounting year and majorly adjusts revenues and expenses. So this entry is the company's general ledger that occurs at the end of an accounting period to record any unrecognized income or expenses for the period. So when a transaction is started, one accounting period and ended in a later period. So an adjusting journal entry is required to properly account for the transaction. So ang adjusting journal entries also refer to financial reporting that corrects a mistake made previously in the accounting period. So these are changes to journal entries you've already recorded. Specifically, they make sure that the numbers you have recorded match up the correct accounting periods. So when you make an adjusting entry, you're making sure that the activities of your business are recorded accurately in time. So if you don't make adjusting entries, your books will show you paying for expenses before they're actually incurred, or collecting unearned revenue before you can actually use the money. So your income and expenses won't match up and you won't be able to accurately track revenue. So your financial statements will be inaccurate, which is bad news since you need financial statements to make informed business decision and accurately file taxes. So to summarize it all, adjusting entries will not only update the various accounts, but can also adjust or correct accounts to be clearly stated soon in the financial statement. So these are the kind of adjusting entries: the prepared expense, the deferred revenue, the accrued revenue, accrued expense, asset depreciation, and a collectible account expense. So next reporter, please.
Okay, so again, good evening, everyone. I am Jumar Moltabalye, and for my topic, I will be discussing to you the accrual method of income and expenses. So, accrual basic accounting recognizes business revenue and matching principle when they are generated, not when money actually changes hands. This means companies record revenue when it is earned, but not when the company collects the money. The method follows the matching principles, which says that revenue and expenses should be recognized in the same period. Okay, so again, to elaborate, accrual method kay kuan ni siya, way ni siya sa pag-recognize sa business revenue ug sa matching principles sa usa ka kanang company. I-record ni siya ang ilang incomes and expenses sa usa ka kanang sa usa ka company. And the reason why I-record na siya, kay naman siya purpose. Ang purpose ani kay para makahatag sila og kanang accurate and real-time view sa ilahang kanang company's finances. And if for example, naay ka ng sales or ka ng i-ship and then ma-record na to siya, ma-accrued na to siya, makanang mahog na to siya sa kanang formula sa accrual method of kanang income and expenses kay even though wala pa naghatag og kanang kwarta ang company, matawag naman na siya kay nakalista naman na siya daan dito, di ba? Giingon diri nga kanang nga kanang na-record na ang revenue when it is earned. So it doesn't mean nga kanang ang gimin diri, it doesn't mean nga na-earned na nakadawat ka og money kanang kuan physically, pero nakaibaw na ka nga kadawat kag money tungod kay na ship naman nimo ang products as I said earlier. So man na ma-follow ni siyang matching principle, which is ang katong income and expenses niya ma-recognize to siya in the same period at a given time. So yes, mao to siya accrual method of income and expenses. So next reporter.
So, good evening again, everyone. So, I am Cherry Luby Soronio. Okay.
And I am Kay Nicole.
So, we're going to tackle about the adjusting entry to adjust prepaid expense. So, what is prepaid expense? So, prepaid expense represent expenditures that have not yet by a company as an expense, but have been paid for in advance in other words, prepaid expense are expenditures paid in one accounting period, but will not be recognized until a later account period. Prepaid expenses are initially recorded as assets because they have future economic benefits and are expense at the time when the benefits are realized, the matching principles. So, next slide please. So, individuals and businesses alike can accrue prepaid expense. In small business, there are a number of purchases you may make that are considered prepaid expenses. So, what is considered a prepaid expense? The following list shows common prepaid expense example. So, first is rent. So, kabaw na tayo, unsa na mga rent, like, kanang sa mga nag-boarding house, mag-rent mo ana. Small business insurance policies, equipment you may pay for before use, salaries, estimated taxes, some utility bills, and interest expenses. So, for the example, kasi Keira ang mo-discuss.
So, good evening again, everyone. So, ang example on adjusting entry to adjust prepaid expense. For example, Company A signs in a one-year lease on a warehouse for $10 a month. Please, next slide. So again, Company A signs a one-year lease on a warehouse for $10 a month. The landlord requires that Company A pays the annual amount for $120 $1,000 upfront at the beginning of the year. So as you can see, example niya, di ba, yung account title, yung debit is, I mean joke. Kanang please, next slide. Please go next slide. So at the end of the month, Company A would have used up 1 month of its lease agreement. Therefore, prepaid rent must be adjusted. So as you can see sa example, iyahang debit is rent expense which is $10,000. While iyahang credit is prepaid rent, same differential amount which is $10,000. So that's all. Next reporter, please.
Good evening, everyone. I am Raven Nicole Sabino, and I'm going to tackle about the adjusting entry to take up prepaid expense. To adjust an entry to take up prepaid expense, you need to recognize the portion of the prepaid expense that has been consumed or used up during a specific accounting period. This adjustment ensures that the financial statements accurately reflect to the expenses incurred during the period So here's step-by-step guide on how to adjust the entry to take up prepaid expense. First is to determine the amount of prepaid expense to be adjusted. Review your prepaid expense account and to identify the total amount of prepaid expenses recorded. This information can be found in your general ledger or accounting software. Okay, and number two is to calculate the portion of a prepaid expense consumed. Assess the portion of the prepaid expenses that has been used up or consumed during the accounting period you are adjusting. So this will depend on the nature of the prepaid expense. For example, if you have prepaid rent for a year, but you are adjusting the entry for a month, you would divide the prepaid rent by 12 to determine the monthly amount. So kaning nga report kay si UV man niya, wala pa man siya, i-continue lang niya unya.
Promissory note, a legal document that serves as a promise to pay back a sum of money borrowed from one party to another. It outlines the terms of the loan, including the repayment schedule, interest rate, and only penalties for default. This document is important because it provides a written record of the loan agreement and helps to establish a clear understanding of the repayment terms between both parties. So it can also be used as evidence in court if necessary. So next. So a promissory note typically includes the following elements. So first is the date the note was created. Second, the names of the borrower and lender. Third, the amount of money borrowed. Fourth, the repayment terms, including the interest rate and the due date for repayment. Fifth, any penalties or fees that may apply in the event of default. Six, the signatures of the borrower and lender. It's important to note that promissory notes are legally binding. So, it's important to carefully consider the terms before signing, mabasa. Before signing. So, so ang promissory note kay usa ni siya ka kanang note nga ibutan nimo dito kanang maglista kanang magsaad ka if kanus-an nimo bayaran imong utang nya if magsaad ka dapat imo jud na siyang tumanon kay nagama man mo promissory note. So, that's all, thank you.
So, good evening, everyone. So, let's proceed with deferral revenue. So, what is deferral revenue? So, it refers to payments customers give you before you provide them with a good or services. So, money deferred revenue is wala siya kaning payment sa customer nga before mo muhatag og ganang services nila. So, the payment is not yet revenue because you haven't earned it. Deferred revenue is common in business where customers pay a retainer to guarantee services or pay for a subscription. So deferred revenue is something called unearned revenue, income, or unearned income. So next slide, please. So deferred revenue example. So to help you understand deferred revenue, so here's a deferred income example. Let's say you run a cleaning business. So customer can purchase a 6-month subscription to get a discounted rate. So they pay you the full amount at the beginning of the 6-month period and you perform the services over the 6 months.
So the amount customers pay you in advance for the cleaning subscription is the deferred revenue. So mo na siya katong gibayad yung mga advance sa katong cleaning subscription. So as you perform your cleaning services, parts of the deferred revenue become earned revenue. So ani siya is imo na siyang gipakita or perform ang deferred revenue mahimo na siyang earned revenue. So if you clean for a client once per week, the amount of money equal to weekly services becomes earned revenue after you perform the services each week. So let's proceed with the next reporter, Maxine Yap.
How to record deferred revenue? You will record deferred revenue on your balance sheet. What type of account is deferred revenue? You will record deferred revenue on your business balance sheet as a liability, not an asset. So receiving a payment is normally considered an asset, but prepayments are prepayments are liabilities because it is not yet earned and you still owe something to a customer. The deferred revenue turns into a earned revenue, which is an asset, only after the customer receives the good or service. Let's say you own a candy shop. So a customer pays you $180 for a 12-month candy subscription. You need to make a deferred revenue journal entry. So when you receive the money, you will debit it to your cash account because the amount of cash your business has received the money. You will debit it to your cash account because the amount of cash your business has increased, and you will credit your deferred revenue account because the amount of deferred revenue is increasing. Next slide, please. So, date account notes, debit, credit. So, cash payment for candy subscription, which is $180, deferred revenue 180 each month. 1/12 of the deferred revenue will become earned revenue. So in this case, $15 per month will become revenue. So you must make an adjustment entry to decrease your debit or your deferred revenue account and increase your credit or your revenue account. So like date, account, notes, credit, and debit and credit. So like or deferred revenue, 1 month of candy subscription, which is $15 revenue, and how to calculate deferred revenue. So deferred revenue is easy to calculate. So when a customer gives you an advance payment, you will increase your deferred revenue account, and also as you deliver goods or services, your deferred revenue account will decrease. So next reporter, please.
So good evening. I'm going to talk about adjusting entry to take up accrued income. So the purpose of adjusting entries is to convert transactions into accrual accounting method. Accrual accounting is based on the revenue recognition principle that seeks to recognize revenue in the period in which it was earned, rather than the period in which cash is received. Accrued income, accrued revenue, any revenue that has been earned but not yet recorded. So adjusting entry to take up accrued income. So I'm going to explain ha. Buwatono na ang mga adjusting entries para sa mga accounts and amounts sa ledger and sa trial balance nga need i-correct. Para makita jud na ngadto kung unsay performance ag financial statements for that period. Ang purpose manggod aning adjusting entries to take up accrued revenue is that para ma-counted tong mga nahalin nimo for that period, months ba or year. Bisag wa pa bayari ana sa customers para makita jud kung unsa inyong performance ug income statement ana nga period. For example, namaligya ko og t-shirts for the month of May. Unya from May 1 to May 31, halos half sa akong halin kay puros inutang sa customers. Nya next month daw sila mo bayad kay wala pa'y sweldo. So ang akong buhaton, inig May 31, magbuhat kog adjusting entries to take up accrued revenue para ma-counted tong mga nangutang nako for the month of May. Kay para makita jud na kung unsay performance og tinuod ba nga akong mga financial statement atong pag May. Kay kung dito tinuod nako nga na-record og mga utang ba nila kay daghan kayog napagawas nga kwarta nya walay income. So dili to siya ma-record. So muraratag na maligya sa wala kay muraratag kanang sige ilista lang ko ni ikaw kuan nimo nya next month nya himan-hima wala dito na lista nya mo to murag nagka kag kanang mga bayranan nga wala din nimo na lista. So mahugra nga wala kay income na nga day or nga month. So for na number 1 example, RDS event agreed to arrange a rush but simple wedding for madly in love couple in afternoon of May 31. The entity is to charge fees 5,300 for the services, which is earned but unbilled. So na-earned na siya pero wala pa bayari. So, ang accounts receivable is 5,300. And the service receivable is also 5,300. So, that's all. So, thank you. So, let's proceed to the number 2 example explained by my partner, Justin Dorado. Thank you.
Number 2. Invested 90,000 cash in the certificate of deposit that paid 4% annual interest. The interest acquired on May 1 and carried on 1 year team to maturity. Prepare the adjusting entry for the month. Kaya siya kay interest receivable income. Kanang ang niya pag kanang i-adjust ni siya sa kanang kanang ang nahalin niya sa 1 month na kani sa May until December na ang kanan ni ang wag ni ang 90,000 times kay mo ang 90,000 kay mo ni ang principal nya ang 4% kay ang rate nya ang time kay 1 year i-times ra na siya kanang 90 times 4% times 1 90 times 0.4 ang 4% mugawas na kay kuan 3,600 nga i-divide na mo siya og kuan ng 12 kay kuan 1 year man kanang mugawas na kay kuan 12 divide 3,600 kay 300 mo na ang i-record nimo sa 1 month nga mo tubo sa imong gi-invest kanang 300 every month. Oh. Mo na i-adjust nimo sa taga month ang 300. Thank you. Next reporter please.
Betcher, Gabion. Betcher man na.
So let's move on to the adjusting entry to record depreciation expense. So adjusting entry for depreciation expense is a journal entry made at the end of a period to reflect the expense in the income statement and the decrease in value of the fixed asset on the balance sheet. The entry generally involves debiting depreciation expense and crediting accumulated depreciation. To adjust an entry to record depreciation expense, you will need to make the following journal entry. So, mo ni siya ang duha ay ang debate is depreciation expense ni ang credit, accumulated depreciation. So, next. The depreciation expense account is an income statement account that represents the amount of the assets value that has been used up or consumed during the current accounting period. The accumulated depreciation account is a contra asset account that is used to track the total amount of depreciation that has been changed to the asset since it was acquired. The amount of the depreciation expense to be recorded will depend on the depreciation method used and the asset's useful life. The most common depreciation methods are straight line, declining balance, and sum of the year's digits. So, to sum up all, kaning adjusting record depreciation expense kay as a company, dapat yun nila i-ensure ang financial statements ana niya through kanang assets, associated costs of using associated cost of value. So kaning adjustment tabang ni siya for more accurate picture of the company's financial performance and facilitates better decision making for management and stakeholders. So next slide. So continue Genesis Gabion. Genesis, your turn.
Okay, thank you. Good evening, guys. Adjusting entry. So, the adjusting entry for depreciation expense involves debiting depreciation expense and crediting accumulated depreciation. So, kita mo sa kining nasa PPT, so mo ni siya ang format na unsaon pagkuha sa solution kay sa total sa date, description, and the debit and the credit. So, for example, adjust Q and Co purchased furniture costing $2,500 on January 1, 2016. The furniture's salvage value is zero, and it's decided to provide depreciation of 10% pay on the original cost. So make an adjusting entry for depreciation expense on December 31, 2016. So, and also how will be the purchase be shown as fixed asset on the balance sheet on 31 of December and 31 December of 2017. So next slide please. So in 31 of December, so mo ni siya depreciation expense is furniture and accumulated depreciation is of furniture. So and debit is 250 and the credit is 250. So the above adjusting entry will also be made at the end of the next 9 years. After that period, the furniture will be fully depreciated at $250 times 10 years it equals to $2,500. The next, wow. Next ko please. So this is the balance sheet of December 31. So furniture 2,500 and less accumulated depreciation niya kay 250 is and the total of 2,250. And the balance of 31 of December 2017 is and furniture is 2,500 and the less accumulated depreciation is 500. Mo gyapon total is 2,500. And balance is accumulated depreciation account on December 31, 2017 is $250 plus $250 equals to $500. Next please. Next please. Repeat. Adjusting entry for bad debt. Companies provide services all sales goods for I can
Kanang Genesis. Amo na na Genesis. Good evening, everyone. So we're going to talk about adjusting entry for bad debt. Companies provide services or sell goods for cash or on credit. Allowing credit tends to encourage more sales. However, businesses that allow credit are faced with the risk that their receivables may not be collected. So, presentation of accounts receivable. Accounts receivable is presented in a balance sheet at net realizable value. The amount that the company expects it will be able to collect. So next slide, please. So net realizable value or NRV for accounts receivable is computed like this. So silbi kanang minus din siya kaning accounts receivable minus gross amount. So sample sa kaning 100 $100,000 minus 3,000 is equals to 97,000. So na. So allowance for bad debits or also known as allowance for doubtful accounts represents the estimated portion of the accounts receivable that the company will not be able to connect. So yeah.
So, hi everyone. Good evening. I am Divina May F. Ampo, and I will be continuing the report of Chairman Jim. So, journal entry for bad debts. To recognize doubtful accounts or bad debts, an adjusting entry must be made at the end of the period. The adjusting entry for bad debts looks like this. So, bad debts expense, aka doubtful accounts expense, an expense account. Hence, it is presented in the income statement. It represents the estimated uncollectible amount for credit sales or revenues made during the period. Allowance for bad debts, aka allowance for doubtful accounts, a balance sheet account that represents the total estimated amount that the company will not be able to collect out its total accounts receivable. So, here is the formula. So, what is the difference between bad debts expense and allowance for bad debts? Bad debts expense, it is an income statement account while the latter is a balance sheet account. Bad debt it represents the uncollectible amount for credit sales made during the period. Allowance for that bad debts, on the other hand, the uncollectible portion of the entire account receivable. So when it kung bad debts gani ang keyword pa niya is uncollectible amount for credits. So muna siya examples guys. Same ra sa format na i-discuss ni Charmin before, i-minus siya na siya. So, sampulan ni Gray Electronic Repair Services estimates that $100 of its credit revenue for the period will not be collected. The entry at the end of the period would be. So, muna siya. So, account receivable amount is actually $3,400 and its allowance for bad debts is $100. Muna siya nasa ubos. The numerator is 3,400 denominator and then the yeah, equals muna siya ang accounts receivable. That's all for my report. Thank you.
Hello everyone. So good evening. My name is Jane Ira Gisolga and I am going to tackle about types of accounting worksheets for financial preparation. So financial professional use a variety tools to help them track important information. One helpful document accountants and bookkeepers is an accounting worksheet or spreadsheets that details different stages of accounting cycle. So if you are interested in developing skills and advancing within your account career, it may be helpful to learn on how to accounting worksheets to create accurate financial statements. In this article, we explore what accounting worksheets are, list some different type of accounting worksheets, and provide steps on how to effectively prepare one. Next slide, please. So what are accounting worksheets? Accounting worksheets are spreadsheets accountants or bookkeepers use to prepare a company's financial statements. Next slide, please. So there are types of accounting worksheets. The first one is general worksheets. Next is detailed worksheets, account receivable and accounts payable list. The next one is production expenditure list, insurance premium list. Next is audit worksheet and 12-column worksheets. Next slide, please. So why are accounting worksheets important? Accounting worksheets are important for organizing a company's financial details and determining whether that business is financially healthy. Professionals who use these spreadsheets can simplify their process by preparing a company's financial statements for each accounting period. Some benefits of using accounting worksheets includes, next slide, please. So this includes improving the transferal of T accounts to adjusted trial balance. Next is reducing the potential for errors when preparing financial statements. Next is highlighting the effect journal entry adjustment have on a company's overall financial statements. Next is helping track a company's accounting cycle steps. Next is identifying why financial statements may not be balancing properly, tracking changes in an account between one financial period to another, ensuring accurate documentation of all details from an accounting period. Next slide, please. So 8 steps for preparing an accounting worksheets. So the first one is write your company's name. Number 2, create column titles. Number 3, place an adjusted trial balance with assets, expenses, liabilities, revenue accounts. Next slide, please. Number 4 is enter your adjustments, including closing stock, outstanding expenses, prepaid expenses, expired expenses, income earned, depreciation, appreciation. Next, number 7, complete the balance sheets with assets, liabilities, and owner's capital. And number 8 is write your closing entries. Next slide. So I think that's all for our reporting, guys.
So that's for our assigned topic. Thank you everyone, and Have a nice evening. Thank you.